Thank you and welcome everyone. Thanks for joining us this morning for our seminar on using options as a hedging tool. A couple of quick administrative items before we get going. The purpose of the seminar today is to take you through some of the principles of using options, some of the advantages and disadvantages, and some structures that we use in our strategies to help maximize return versus risk. So I mentioned that we're going to take a look at options and their uses and the ways they can help enhance returns in a equity portfolio. I know there are many on the line who are more familiar with options and some that are much less familiar. So to try and accommodate everyone, we do have some slides that will sort of introduce the concept of options, which will feel a little simplified for those of you who have more sophisticated experience with options, but don't worry, we will get into more complicated expressions of option positions toward the end of the webcast. I want to start quickly with slide 5, looking at a quote. I've had this quote for a number of years from Howard Marks, who, as many of you will know, is a famous investor, one of the luminaries in our industry, founder of Oak Tree Investment Management, and somebody who has seen many, many cycles. And he was giving us a talk and talking about the challenges of forecasting. And his point of view was that you don't really need to worry that much about forecasting because in terms of where we are in an investment cycle and what sort of risks you're taking, a lot of what you need to know is present just in contemporaneous information, things that are happening right in front of you. And so I wrote down his quote, and I highlighted a couple of the key lines because they do seem particularly important given some of the sentiment that's out there right now. So his quote was, in terms of looking for clues to the future, look around and ask yourself, are investors optimistic or pessimistic? Do the media talking heads say the market should be piled into or avoided? I highlighted this next one. Are novel investment schemes readily accepted or dismissed out of hand? Are securities offerings and fund openings being treated as opportunities to get rich or possible pitfalls? Has the credit cycle rendered capital readily available or impossible to obtain? Are price-earnings ratios high or low in the context of history, and are yield spreads tight or generous? All of these things are important, and yet none of them entails forecasting. We can make excellent investment decisions on the basis of present observations with no need to make guesses about the future. And I think most of you would agree with me that almost all of these items are pegged to the optimistic side. Certainly, the current Bitcoin mania and blockchain mania is a fairly novel investment scheme that people seem to be piling into without really even understanding what it is they're doing. And for someone like me or for others of you who've been around a long time, it does remind me very strongly of the dot-com mania in the late 90s. If you look at the next slide, on slide 6, I showed that, the standard market cycle that we all ride through time and again in the investment industry. And we are, people I think generally agree we're in the later stages of a bull market. There are certainly forecasters out there talking about a bull market that could go on still for another decade or more because of an accommodative central bank. My personal view is that we're at the late stages of this run. I'm not of the view that it's over. I could very well go another year and a half or 2 years. But we're certainly at the thrill stage where people are doing things similar to when they're at the gambling tables in Vegas and they're winning. It just feels so good and it feels so easy. We see a lot of that behavior happening today. If you look at slide 7, I always bring this back to how should that impact how we manage money. And I use 2 contrasting time periods that we're all familiar with, or at least most of us are familiar with. Contrast the bottom of the last cycle, which was March of 2009, with the top of the last cycle, which was October of 2007. And if you think of what kind of attributes you would have wanted to have had to have been managing money at either of those points in time, well, certainly back in March 2009, the most important ones were, 1, to actually have some capital to put to work, but number 2, and far more difficult, was to have the nerve to put that capital to work. I was running about $1 billion portfolio at that time. We were buying stocks in March of 2009. It did literally make me want to vomit when we put the trades in. Even as we went through the end of March, and I think we bought our first banks towards the end of March. They had a nice pop off the bottom. It still felt incredibly difficult, given everything that had happened in the prior 18 months, to put that money to work. Contrast that with October 2007, also felt very difficult to do very different things. Very difficult to be cautious, very difficult to say I've got risk controls, very difficult to pass up what looked like easy investment opportunities and try and be more selective. Those would have been the right attributes to have in October 2007, but again, very hard to miss out on all the good times that everyone was having. Certainly, most of the time we're at neither of those extremes, and we always talk about you need to be somewhere in between. We do feel like the kind of attributes we should be displaying in our portfolio are veering more towards the October 2007 type of qualities. We're not worried about having nerve and putting money to work. We're more worried about being cautious and a little more selective in terms of how we're putting capital into the market. Just a couple of thoughts before we move on from this slide, and I apologize I didn't add this slide, but a common measure of risk-adjusted returns is the Sharpe ratio. It's the return you achieve over the annualized standard deviation or the volatility that you experience realizing that return. If you look at the broader market, the S&P 500, I have a chart from 1928 to 2016. So over that, 88-year period, the Sharpe ratio of the S&P 500 varied year to year from a low of -2.5 to a high of plus 2.5. It basically bounced between those two levels. And averaged over that entire period 0.4. So there was no single year in that 88-year period where the Sharpe ratio exceeded about, I think it was 2.6 on the upside. This year, the S&P 500 year to date, and we've got about a week and a half left, has achieved a Sharpe ratio over 5. So over twice any Sharpe ratio it has ever achieved, because of course we're having excellent returns in an era of unbelievably low volatility. That feels great. That is awesome. That is not just as good as it's ever gotten. That's much, 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 much better than it's ever been. And again, those are not the sorts of things that typically happen early in a cycle. On slide 8, we look at some of the challenges for portfolio construction. I show the different layers of risk and return that asset allocators are typically trying to construct portfolios with. I know many of you do this for your clients on a regular basis. Depending on their risk tolerance and their financial plan, you're going to have different allocations to the speculative layer, which that very high return, high risk type of investment. I'll put Bitcoin and blockchain type stuff in there. Most will have a very large allocation to tactical, what we'll call market beta, so long-only portfolios in the bond and equity realm. And then for most investors, they'll have an allocation to what we call core, which is lower risk with a reasonable rate of return. So not as much focused on what the market itself is doing, but just trying to grind out a reasonable rate of return at a low level of risk. They're nest egg money. And in an era of very, very low interest rates, achieving that core return has become much more difficult. And of course, now with very elevated equity multiples, that's become even more difficult. Our goals on slide 9 are to try and help people achieve those core reasonable return at low level of risk. We look at risk in terms of protecting against large drawdowns. We are an equity-oriented strategy. We're very aware equity markets can go through periods of large drawdown, and we want to protect our clients against those drawdowns regardless of market conditions. So there's no excuse to say, well, it was a bear market. We're explicitly designed to help protect against those eventualities. From a return standpoint, our goal is to generate a positive non-correlated compounding return. Again, we're not long-only benchmark-oriented, but we are expecting to drive positive returns year over year to help clients keep compounding that core return. And in terms of volatility, we are also very aware that the journey is often for the client as important as the endpoint. We need to be able to keep them on the path, and so we do focus on maximizing the amount of return we generate per unit of risk that we take. So that's what we try and do. We use options to help mitigate risk in our equity portfolios and manage volatility. So we're going to spend some time now looking at options, how they work, and how they can be used in an equity portfolio to do just that. For those of you less familiar with options, options are just a financial instrument that specifies a contract between two parties for some future transaction on an asset at a specified price. So that's the formal definition. What it really means is you, as a buyer of that option, you gain the right, but not the obligation, to engage in that transaction on or before a certain date. So it's called an option for a very good reason. You get the option to do something, but not the obligation to do it, as long as that transaction happens before a certain date. Now, if you're the seller of an option, that's a very different thing. You're the one now providing the obligation. So a seller of an option incurs the obligation to fulfill the corresponding transaction on or before a certain date. So you don't get the right to choose as a seller. It's up to the buyer to decide whether they exercise the option or not. One of the things we talk a lot with clients and people in the industry is about option prices and what makes them move. Most people focus on the underlying price of the asset that the option is on and expect the option price to move very directly with the underlying stock price, as an example. That is actually only one of three things that move the price of an option, and all are very important. So any option has a strike price on it. That's the price at which you have the right to engage in the transaction, either to buy or sell the underlying security. The distance to that strike price is very important. As it shrinks, your option price will go up. Simply, you're getting closer to the price at which you can engage the option, so it has more value. Similarly, if you get farther away from the strike price, the option price is going to go down. Now, there's a measure of how much the option price moves as the underlying security price moves. That's called delta. That's a kind of Greek term you'll hear a lot with options. But that's an important relationship, obviously. The closer you get to the strike price, the more the option price will want to move higher. But similarly, all of these options are reliant on a time frame. There's a time to expiry. Literally from the minute you buy an option, the clock is ticking to that expiry date. So as the time to expiry shrinks, so does the value of the option. Simply put, you have less time to get to that money zone above the strike price. So the less time you have, the less value there is in the option. And the measure of how the option reacts to a one-day move in time is called theta. And finally, volatility is also very important. This often is confusing for people. They can sort of understand time because the contract is shrinking. There's only a certain amount of time left. They can certainly understand price, but why should volatility matter? Well, the more volatile an asset price is, the more likely it's going to move to your strike price. If it's not moving around very much, if it's not very volatile, then it's clearly going to be harder to have a move up to your strike price or down to your strike price. So the higher the volatility, the higher the value of the option. And importantly, this is expected volatility. So the market's always implying a level of volatility in the future in an option price. And where this can matter is, imagine you owned a call option. We'll look at a call option in a minute, but this is the right to buy the underlying stock at some strike price. And imagine that option expires 2 weeks after the company's earnings call. So the company has their earnings call, and it turns out they met expectations. There was no real surprises. The stock really didn't move at all. And then you go and check the price of your option the next day, and you find that the price of the option has fallen. And you're surprised. The price of the stock didn't move. You've only gone forward 1 day in time. Why should my option value fall? Well, the expected volatility of the stock price has fallen because the catalyst for making volatility happen, the earnings call, is now past. So with nothing more to happen between now and expiry, you would expect volatility to drop, and so the value of the option drops. So those are the three things that you have to keep in mind when you're looking at option pricing. When we're structuring options in our portfolio, we're always modeling each of these three elements to figure out not just what we should pay for an option, but what the performance of the option will look like under different sets of outcomes. So if we imagine what happens if volatility keeps dropping, what happens 2 weeks from now when I've lost some more time value, what happens if the price moves up or down 10%. We play with all three of those axes to model how our portfolio will react. If you look on slide 12, we look at, we call the marketplace for volatility. I mean, the standard measure that you'll hear a lot about is the VIX, which is measuring the realized volatility in the S&P 500. There's been a lot of chatter. I've shown the slide here from 2007 to today with the two red circles on either end of the chart. Back before the financial crisis, all the chatter at the time was historic lows being achieved in volatility, printing all-time lows just below 10 on the VIX for the S&P 500. And of course, from those levels, we went much higher, over 80 on the VIX, just a year later when Lehman failed and all hell broke loose in financial markets. We then, as we came through the financial crisis, had a period of bouts of elevated volatility surrounding the euro crisis with Greece and then Italy in 2010 and 11. But generally speaking, we've been getting more muted in terms of volatility up to the current period where we're printing, we've been in the longest period without even a 2% correction ever. We just crossed that threshold about 3 weeks ago. But on the right, you can see, an old rule in the world of options is you want to sell options when premiums are very high, because generally speaking, the premium value is more than compensating for the risk of having to exercise the option. Whereas when volatility levels are incredibly low, you should be wanting to buy the option because you're not paying much for that optionality. Now, that's what you should do theoretically, but as is typically the way, markets generally are doing the opposite. So a very popular trade right now, because volatility has been going down for some period of time, is to sell volatility. So people selling puts and calls on underlying stocks and on the index itself. And that's not because it makes good financial sense, that's just because it's been working, and as long as it's working, people keep doing it. And similarly, when volatility was very high in 2008, there weren't many people that felt like selling insurance on the S&P 500. Most people were still buying it at that point. So let's quickly look at the difference between a call option and a put option. I think all of you probably know this, so we aren't going to spend a ton of time on it. But I've just shown a quick chart. If you own a call option on a stock, you paid a premium to own that option. So if the stock expires left of the strike price, below the strike price, then you're going to be out of the money by the amount you paid for the premium. And if you move above the strike price, then the call will start to pay you money. And as soon as it pays off enough money to cover your premium, you start to make a profit. And so you can see that's why the profit line lags the payoff line. Similarly, if you look at a put option, it's the exact opposite. A put option gives you the right but not the obligation to sell the underlying stock, as opposed to the call option, which gives you the right but not the obligation to buy the underlying stock. And similarly, you pay a premium for that, and once the stock drops below your strike price and you have the right to sell at the strike price, you earn a payoff, and your profit is achieved once you cover your premium. So those are the two major equity options that are out there. We only use listed options in our portfolio. That's all I'm going to cover today. I'm not going to get into over-the-counter stuff. On slide 15, we look at some of the pros and cons of using options. I'll talk about the advantages first. Number one, and this is a very important advantage that we're going to come to in a minute when we talk about protecting your portfolio. You have the potential to earn a very large payout relative to the small premium paid. So there's a lot of implied leverage in an option. You can put up a little bit of money and achieve a very large payout. which if you think about it, can be very similar to an insurance policy. When you buy insurance on your house, you don't pay the value of your house in insurance. You pay a very small fraction of that value. And if something bad were to happen to your home, you receive a very large payout relative to what you paid in premium. The second key advantage is that the option is directly tied to the underlying asset. So you're not worried about whether it actually is going to work or not. If you own a put option on a stock and the stock goes down, then the put option's going to go up in value as long as it goes down enough. So the matching is very tight, which is good. Number three, there are a wide number of ways, a vast variety of ways to use puts and calls together to combine them and create a myriad of different outcomes. There's almost an infinite number of outcomes that can be created by combining long puts with short puts, long calls with short calls, puts and calls together. And we'll look at a couple of simple examples of those in a few minutes. But anyway, it does give you a lot of flexibility to manage your underlying equity characteristics. And the fourth advantage I put down is the fun one, which is there's a point in time when your option, the underlying stock or index that you bought the option on is approaching your strike price. At that point, the value of the option starts to move very, very quickly. And if imagine you own a call option on a stock at $20, as that stock approaches $20, the value of the option starts to escalate very, very quickly. And that certainly, when you're the owner of that option, is a lot of fun. I'm going to talk quickly now about the disadvantages. I mentioned this earlier, but number one, these are all time-oriented and have time to expiry. And so the minute you own the option, you're losing some value with time. So you will lose value if you're long an option every day. You'll lose some time value, I should say. You could be more than making that up if the stock's moving towards your strike price or if volatility is moving higher. At expiry, if you own the option and you did not achieve your strike price, then you have the potential to lose 100% of what you paid in premium. So this is why you don't put all of your money in an option. That's an all-or-nothing transaction. If it doesn't get there at expiry, you'll lose all of your premium. And number three is the flip side of the advantage I just talked about, which is if you're near the strike price and your underlying stock starts to move away from the strike price, then just like it felt like fun as your value escalated and your option escalated in value quickly, your option will now decrease in value quickly. So that works both ways. That point in time where you're, what we say, where the delta is moving very quickly, where there's a lot of, another Greek, gamma in the stock, it can feel great if it's working in your favor, and it can feel really painful if it's going the other way. So those are some of the pros and cons. We're going to talk about how we use them, both to protect an overall portfolio and to enhance individual stock positions. I mentioned earlier the concept of insurance, and house insurance in particular with the put option. If you think about it, most clients' equity portfolios are incredibly important investments for them, just like their home. Most, and certainly our equity portfolio is a very large cap portfolio that's well diversified across sectors. In an instance where the market melts down, we can own protection against declines in the values of our stocks by owning a put on the underlying market. In our case, we're most often using the S&P 500. So if you own a put option, just like if you think about a house insurance policy, I pay a premium for a period of time to protect a certain value of an asset. In this case, it would be the S&P 500 at a certain price. And if in that time limit something bad happens to that asset, let's just imagine the S&P 500 declines 20%, then I'm going to get a big payoff on that put option, which would be similar to the insurance payoff you get on your house if it burned down. So if you imagine structuring a portfolio that way, which is at a simplified level what we do, then the first instance I have on the top of the dotted line is what happens if the market rises. Well, our stock portfolio should be realizing gains on individual stock positions, so that's good. and our index insurance is going to lose that premium we paid on those index puts. So we'll make money on our stocks, and we'll give a little bit of it back on the index insurance that we paid on the index put. Now, if you go below the line, what happens if the market falls? Well, we would expect to have losses on our individual stock positions, like most people would, but we expect those losses to get offset by gains on those index puts. So our goal, because we're going to look at this on the next slide, because when the market rises, I can really only lose the premium, but when the market falls, I have this huge payoff that's possible. Our goal is to reduce the downside that our portfolio experiences much more than we reduce the upside. And so I'm going to show you a couple scenarios where you marry a put option to, in this case I just did it on a stock, but it would be the same with a put option on an index. So at initiation on the left, I'm on slide 17, you can see there's some value of stock, and then that small dark blue bar to the right is the value of the premium I've paid for the put option. If you move to the right, we look at a scenario, what happens if the stock moves higher? Well, you can see the green arrow, the value of the stock is now bigger. That premium, I've lost some of it because it's a put option, and as the stock moves farther away from my strike price, the value of that option goes down. But still, I'm higher than my total value of my portfolio is bigger than it was before. The next scenario, if you move to the right, is what happens if the stock goes down? Well, you can see the red arrow now, the value of my stock has shrunk, but my dark blue to the right has gone up a lot. The put has moved into the money and is paying me a relatively big payoff. And so I've lost a little bit of value, but not nearly as much as the stock has gone down. And so it's massively reduced my downside. And of course, the last scenario is an important one when you own options, which is what happens if there's no change at all? Well, my stock is exactly where it was when it started, but I've lost the premium value of my put. So it's not a great outcome, but similarly, I compare it to people at the end of the year. They don't go to their insurance agent and complain that they didn't get anything back on that premium they paid to insure their home. That's just the cost for us and for our clients of being in the market. Now, for us, we apply this in a way that's fairly a little bit more sophisticated. So we're always looking at the types of equities we own in our portfolio and the amount of each one. We measure risk at different market outcomes. So we model what would happen if the market fell 5, 10, 15, 20%. And then we own puts at different strikes and expiries that will pay off to mitigate how much downside our portfolio experiences in those scenarios. So what I've shown on this slide, on slide 18, is our modeling tool, which along the horizontal axis shows those potential market outcomes. As you move to the right, it's the market going up, and as you move to the left, it's the market going down. The diagonal blue line that runs the sort of 45-degree angle through the chart is the index return. So if you owned an index ETF, you'd expect to go up as much of the market to the right, and similarly, if the market drops, you'd expect to go down as much of the market. Our lines are the red and blue lines. We modeled a couple of different portfolios on here, which show on the downside, as the market drops, we lose money as well, but our puts start to pay off and they mitigate those losses. And then if the market falls enough, and typically that's something over 10%, we start to bottom out, and if the market keeps falling, we can, in fact, even make back some of the money that we've already lost. And that was our experience in 2008. Every scenario is different. I'm not saying we're going to have another 2008, but the principles are the same in terms of owning large payout put options. On the upside, though, you can see that drag in the return is because we're burning premium on those put options. They're obviously not adding value on the way up. They're just subtracting value. So that's how we model our portfolio. Each day is different as our portfolio value moves higher, as the index moves higher. We're constantly remodeling and looking at how we need to move either our put options or adjust our equity positions to keep our curve where we want it. We have a lot of sophisticated tools to do that, but the principles are pretty much the same as we've just talked about here. I'm going to talk about two quick other strategies you can use with options that we would use in our portfolio. The first is a put spread collar. This is a situation where we own a stock. In this case, it was Apple. We would sell a call above where the stock is trading, and we would own a put spread below the stock. A put spread is where we're long a put close to where the stock is, and then we sell a put further down. That combination, that's three options together on top of a stock, gives you the table you can see on the right, where we compare what would happen if the stock moved a certain amount to what would happen with our combined position on the right. So you can see if there's a modest upward move in the stock, in this case just under 5%, we actually do a bit better with the strategy, where we earn the return on the stock to that point, plus the dividend, plus, in this case, we had a small credit for doing the put spread. In fact, if the stock didn't do anything at all, we still did better with the dividend plus that credit. And similarly, if the stock fell, we did much better. A 12% drop in the stock, we only fell 1.5%, whereas an 18% drop in the stock, we fell about 8%. So that's just an interesting way to take a stock that may have a lot of volatility and use options to give yourself more upside on a modest set of upside outcomes and better downside protection. And in fact, we do this sort of thing on stocks in our portfolio quite often. The last one I'm going to talk about is the potential to do something very different, which is just, and this is something we've been doing a lot the last 6 months, so I did want to include it. Volatility has gotten so low in the last year that it started to become more attractive at times, in certain instances, to actually, instead of owning an underlying equity, to just own a call on that equity. Calls were so cheap that if the equity actually moved higher, you had the potential to outperform to the upside, but if the equity moved lower, because you only had the premium at risk, you actually suffered less downside. So there was a way to structure positions with calls that looked far more attractive. And in this instance, we did a trade with the S&P 500. We had some extra cash, and we decided to put to work going into this whole tax reform that is being underway in the U.S. We felt there was a lot of potential upside in the market. This was about a month and a half ago. We didn't feel like the market was pricing in the potential for the Republicans to get tax reform done. Since calls were so cheap, it was there was a nice potential payout if the market did move higher. But if they didn't get tax reform done, we actually stood to lose less money than we would have if we just owned the market generally. And so if you look at slide 21, the gray line shows you if you just owned the S&P 500 and the S&P 500 moved up 1, 2, 3, 4% versus moving down 1, 2, 3, 4%, you're going to get that straight line relationship. But if you did the structure that we did with calls, we actually had the potential to outperform on the upside if the S&P moved 2 or 3%, which it has. But yet, if the S&P had moved lower, we also were going to outperform because we didn't have the downside experience. We only had our premium at risk. So it gave us we like those types of curves where we live above the line that you get from just owning the underlying security. And in particular, we like those situations where the outcomes are somewhat uncertain. So it's kind of binary. Things could go either way. It's always hard to know for sure. I mean, let's face it, it's Donald Trump. He could have always done something crazy at the last minute, and for all we know, he still might. But it gave us a much better way to have market exposure than just to actually own it. The last one I'm going to finish with is energy, which is actually an area that has obviously not done well the last few years. It is, in our view, the cheapest part of the market. The last couple of months, we've been building exposure in energy. We do think there's potential for oil to hold these levels at or near 60. We do not think the energy-producing stocks reflect that value. And so we did a similar type of trade using calls on the ETF for energy producers in Canada, the XEG. And you can see if the XEG moves up, our blue line has a very similar upside experience to just owning the XEG. But if we're wrong and energy moves down, then we have less than half the downside that we would if we just owned the names directly. So that's another example of using options to reduce your downside and still manage your upside. So with that, I want to thank everyone, and we look forward to meeting with you all in the new year. Thank you.